I don't need audio on it.
You need audio on that one. I'm gonna mute myself here. Make sure.
Fade on it.
Audios. Yeah, audios.
You say something?
Yeah.
Yeah.
Test.
Yeah.
So Mexico just left. Dude, I don't know why he expects us to. I think I'm gonna just tell him we start 30 minutes later than we do and give him the time for 30 minutes. I think I'll be for 15 minutes. Do you guys know like what monetary policy is? If I told you what it is? Like if I asked what is monetary policy? What about like central bank inflation target? What is the US's inflation target? 2%. Yeah, okay.
Is that like 2.2?
Because our boss from this summer wants to give a guest lecture next week on like international finance, macro, and FX. And I told him, I was like, oh, like you take the second 30 minutes. For the first 30 minutes, I want to cover like what is the Fed, what are central banks? And then he sent me a sassy email back saying like, oh, I would hope Princeton economics can teach students what a basic monetary policy looks like. And I was like, sorry. Yeah, he's really quirky. But he's cool.
You said it's not here?
Huh?
He's not here?
No, he has a PhD in finance and from Stanford and a CFA. He's
He did
really
math. He did math.
he did math at Northwestern. He's really smart, but he's very
He
high
did. He
standards.
was a quant at Sigma as well, I think.
Yeah. He used to like do credit trading. Securitized products actually, which we'll cover today.
The DOD, yeah, you wanted. Who should have wrote that? Yes. They're both running. They are, yeah. Oh, yeah. No, not this. That's the thing. But we're just small, so. What is she?
It's an accident.
There's a guy who's called that he lists a whole bunch of.
We'll give it like 2 minutes and then get started.
Here's a couple of. I'm going to look this is the best.
Let's get started. Yeah, welcome back. Hope you guys had a good break. Last week we didn't have a lecture because of elections, obviously. Yeah, let's get straight into it. So quick admin stuff. Obviously, we have that live Q&A up again, so feel free to ask any questions there. And if you are here, you probably got the emails from me, but just in case you haven't, interest forms there. I forgot to send a lecture 4 recap with the slides and the recording and stuff. I'll probably send it with this one, and the homeworks will also be included in that. It's going to take a little bit of time creating those for you guys. And give me feedback on those if they're helpful, if they're not helpful, too hard. If you need an answer key, I have those. And yeah, today's slides are a slightly new format. So if you don't like it, you want to go back to the old format, let us know the interest or the feedback form at the end. And today, Caroline, one of my good friends, she's incoming analyst at Bain Capital, which is a PE firm, huge PE firm, and she'll be giving the PE slides today. So yeah, I'll pass it off to Caroline.
Yeah, so I think just briefly talk about private equity first, kind of as an industry, as the industry itself. It's like a very rapidly growing industry, growing over 4x from 2000 to 2023. Broadly, I think there are 3 different segments of private equity. First is like buyouts and like majority recaps, which are like more mature companies. Then we have growth equity and venture capital, which are more early stage companies. Venture obviously being a little bit earlier, and like you're not necessarily buying a majority stake in the company. And growth equity, like putting in a little bit more meaningful money and having a little bit more of an operational say in the company's growth prospects. Furthermore, real assets and credit can also be considered PE, depending on, I think, like the exact type of real assets you're investing in, or credit in how you choose to pursue it. Something to think about really when thinking about the, I guess, total addressable market for companies that you could really look at as a PE firm. Like, you know, the majority of US companies by far are private, while there are only like, you know, less than 1% of US companies are publicly traded. So that really leaves like a lot of room for different forms of consolidation or different forms of acquisition potential as a private equity firm. And yeah, so I guess as you can see here, like private equity returns have been very solid over the past 20 years, and as a large reason why the industry has grown so quickly. Typically, something to note about private equity returns that like allows for them to be higher is that like PE investors typically have to deal with the fact that private equity as an asset class is relatively illiquid. Does anyone want to take a stab at why PE investments might be illiquid? Yeah, definitely. Kind of in that vein, essentially like private equity, because of the fact that you're like buying and selling entire companies, and you're not like buying, you know, individual stocks or like more accessible forms of ownership in a company, it means that it's very hard to like, you know, one day I decide I want out of this company, like I can't just sell it the next day. Like it's a long process, and typically also returns are like over long periods of time. It's like probably more akin to fundamental long only investing, whereas like a lot of other forms of like stock investing may occur over a time frame of like a couple of days or even a couple of hours, depending on different stock movements, particularly in like quantitative trading formats. But yeah, I guess for some kind of quick terminology on private equity itself. So first off, private equity funds consist of 2 main forms of investors: limited partners as well as general partners, or LPs and GPs. For limited partners, those are typically like institutional investors, such as like pension funds. Our endowment is invested in a bunch of private equity firms, or like in high net worth individuals, as well as like family offices, which typically will invest their money into private equity funds. This is called a limited partnership because these funds don't necessarily have a say about what companies the private equity fund chooses to allocate capital to. On the other hand, general partners are essentially like the partners of the firm itself. So that's like, you know, like they have a direct say in what companies are being invested in. So that's why like they're not known as general partners, while they're the other side is limited partners. General partners also obviously take on a lot more of the risk in that they are personally indebted if, you know, issues in the private equity fund go off. Like in that, like limited partners, all like the worst that can happen is like they can just lose all their money. Whereas general partners, theoretically, if a private equity firm goes under, they could owe a lot of people a lot of money. And then, yeah, so then these 2 parties essentially invest into the private equity fund. And this money gets split by the private equity fund owners into various different portfolio companies or portcos. So, with an individual private equity fund, many firms will be investing in like 10s, 20s, et cetera, of different portfolio companies, buying them out with, debt, by taking out debt, and then ultimately then after selling these companies, returning capital to their shareholders. Something to note about how the private equity fund is actually structured in terms of like when the cash comes in and comes out is that there's such thing called cash calls. Is that what you said it's called?
Capital calls.
Capital calls, that's what it is, yeah. So capital calls, and essentially that means that like when a private equity fund actually gets money from the investors is only when a portfolio company is bought. So basically if I fundraise all of this money for a given fund, that money doesn't actually come to me until I start buying different companies. Once I buy like portfolio company 1, then I will go around and ask my investors for the capital to actually buy that company. So then something else to think about with private equity is I guess like the real time flow in terms of like how returns are really generated. So there's this thing called the J curve, which is essentially like a measure of cumulative net cash flow over the years of a private equity fund. So initially net cash flow is strongly negative because of the fact that you're buying companies, you're improving them operationally, you're investing, and so you're like using money in this area. But over time, near the end of the fund, as you continue selling off companies and you make returns on your capital, then you ultimately reach this period of positive net cash flow. And ultimately, like if you theoretically summed up these like smaller gray contributions bars and then like summed up your distributions, you ultimately get, I guess from this graph, a 2x multiple on invested capital, which essentially means that, for every dollar that you had to put in, you're going to get $2 out. And something to note is that I think we think about returns in 2 different ways. The multiple on invested capital, or which is also known as MOIC, as well as IRR, which is internal rate of return. The IRR is essentially a measure of time-based return because I think hopefully you guys have covered the time value of money, but essentially $1 now is worth more than $1 a year from now. So essentially it's kind of taking the fact that your returns aren't all happening at year 12 once you've returned all the capital. It's actually happening, in year 6 when you sell the first portfolio company, and then in year 7 and so on and so forth. So taking into account the time at which these cash flows come in will allow for a better picture of like what your returns actually are, which is measured by the IRR. But both are really valuable in terms of making investment decisions, because both of them can have their different biases. Like on the other hand, like IRR, because it's time-based, like might overvalue a short-term investment that has a decent change in like overall price, but like from a MOIC standpoint, it wouldn't be that attractive because of the fact that like maybe your company only went up by like 0.5x, which is like not ideal, but like by an IRR basis, if you do that within like a year or like 6 months, that'd be really attractive. Whereas like with private equity funds, because we're largely liquid, definitely have to think more about like the long-term gains, which like I think both MOIC and IRR can account for in different ways. I guess for the rest of this, we're going to largely talk about like where return actually comes from in private equity. So first off, we can talk about like just broadly, when a general partner buys a company and exits at a 2x MOIC, so essentially they've made 2 times their return, their invested capital, what really drives their returns? I think this is largely broken into 3 things. First off, growth in EBITDA, growth in multiple, and growth in leverage. So as you can see here, like one of the graphs that we really like creating in private equity is kind of like this graph where you start at your entry value and then ultimately get to your exit value and like think about the different ways to bridge towards there. So like largely, as you can see here, like this theoretical company is actually largely the returns are driven by the fact that you have leverage on it, which is true for a lot of buyout firms, just because leverage is able to like increase returns dramatically. Furthermore, you also have a decent amount of multiple expansion, so that's like the intrinsic value of the company has increased. Someone is willing to buy it at a higher multiple than you were willing to buy it for. And then EBITDA growth, which is like largely due to like increases in operational efficiency and different things we'll talk about in a couple of slides from now. So the first thing I think we're just gonna like kind of give some color as to how these different things can actually drive returns. So let's just say that you enter company A at a 5x multiple and company B at a 7x multiple. Then ultimately you get to your overall cost for both of these companies to be $1,200, because each of them you're entering at, I guess, an EBITDA multiple that's implied. So you have 100 times 5, 100 plus 100 times 7, and you get 1,200. Then in 5 years, you're making no operational improvements, so you have no improvements to your EBITDA, essentially is what that's saying. And then you exit at an average of a 14x multiple, so an average between the two companies. So then the overall, your actual exit multiple would be 200 times 40, because you've like, it's an average, so you're just summing up the two EBITDAs and then applying the multiple to the entire the entire combined company. So you ultimately exit at a price of 2,800. And then from here, you get that your multiple on invested capital, which is essentially again, like you've invested 1,200, now you're getting 2,800, so you get a 2.33x MOIC, which translates to an IRR on a time-based scale, accounting for the fact that you exited 5 years later. So this is, I think, relatively simple. Essentially, you're just saying that you were willing to buy the company at a lower multiple, and then you're selling it to someone else at a higher multiple. And like reasons why I guess you would be able to sell at a higher multiple is that like maybe, you know, sentiment about the broader industry has changed. Maybe you've made operational efficiencies to the point where like the company is just inherently better quality, or like there are other things about like that investors believe that the company's future cash flows are worth more than what you thought 5 years ago, which is probably largely due to operational changes. So like I think a lot of these different growth levers are kind of intrinsically tied, but ultimately like multiple expansion can also be due to like broader sentiments about industry. Like for example, like tech right now maybe is trading at like all-time high multiples, whereas like that was different at like the end of the bubble burst and so on and so forth. Yeah, the next thing we can talk about is EBITDA growth. So essentially, again, let's say we're still entering at 5x and 7x, and the initial year zero EBITDA was $100 for each company. You still get this entrance value of 1,200. Then we can exit 5 years later, growing EBITDA by 30% in both companies. And now we're like not changing the multiple compared to entrance. So even though we've made operational changes, let's say that these are all independent events right now, and like the firm that we're selling to would only be willing to buy at the 5x and 7x multiple. Then we ultimately get, I guess because they're equal values of EBITDA, and you can essentially just take the average of the two multiples to apply the 6 multiple. But theoretically, this is also just 130 times 5 plus 130 times 7. And you ultimately get your exit valuation of $1,560. Again, applying the MOIC formula, we get a 1.3x return and a like lower IRR because your overall return on your invested capital was smaller. So on a time-based scale, that still translates. Yeah. So I think like EBITDA growth is like, we'll kind of break it down a little bit more later, but ultimately like is an important driver of returns. But I think like what's valuable about EBITDA growth is that like with the operational changes you're making, it'll also ultimately change how like other investors are thinking about your company when they ultimately buy it. Then the next example is just like leverage. So again, we're entering with the A and B together worth $1,200, but instead we're going to actually enter with 50% leverage. So we've taken out $600 of debt. We're taking out $600 of debt to buy the company, and we're only putting in $600 of our own money right away. So then we exit 5 years later. We again grow EBITDA because we like, I guess debt does like enhance returns. So this is kind of showing that like this return will be higher than the EBITDA only return. So we then, you know, exit at the same multiple as entrance. So ultimately we get, 260 again times 6, and we get that 1,560 number. And then we're assuming that there's no interest on the debt. So essentially at the end, you'll still have to pay out your debt because, you know, your debt holders gave you money to buy this company. So you pay them out now, and then you actually get $960 back. So here you've actually made, I guess I see. Okay. Well, wouldn't your multiple invested capital be 960? Yeah. So I guess like theoretically your actual multiple on invested capital would be 960 over 600 because like you now retain $960 and you paid initially $600. So that is a little bit inaccurate, but like theoretically that means that your multiple on invested capital will be higher than this number, which then means your IRR, which this is actually accurate, is 9%, which is higher. So I think you guys talked about this in a previous lecture, but essentially leverage is important because it reduces the amount of money you have to put in, and because the cost of debt is lower than the cost of equity. So your debt holders demand a smaller amount of return, so you can take more of the pie and essentially enhance your returns. But there's also obviously a risk because of the fact that you would also like have to pay down your debtors, even if the company is not as successful. And the debtors are given access to the capital first. Yeah, so I guess what I think is like most core to private equity, and I think is like really the most pure form of private equity investing, is like thinking about operational improvements, which is essentially impacting EBITDA growth. So EBITDA growth can then be further broken down into two components. First off, revenue growth, and then margin improvement. I think revenue growth is mostly tied to like the market at large and like the addressable space, the addressable universe, which is essentially like your customers. And I think like to really think about it, like to really think about your potential revenue growth, you're really thinking about like what percent is your industry growing at, what percent, like, so like theoretically for like a good company, you should be at least growing at like your industry percentage, right? Because like for however much your industry is growing, that means like your customer base should be growing at around that same rate, and you should at least be maintaining your share within that industry. But then thinking about revenue a little bit further is then like, how do we gain share over competitors? Thinking about competitive edge, thinking about like, I guess like differentiation, developing a moat, developing like increasing your switching costs from one company to another. These are really important ways that you think about like growing and maintaining your revenue. And I think like thinking about markets, both from a market growth segment as well as like a percent share, is really important. And that's like really through analyzing like your customers and what they want, and like how you as a product or a service can differentiate yourself. As for margin, I think that like is really tied to just the operations of the company. So theoretically, as I think like the most important thing is like economies of scale. So essentially, as you become larger as a company, you essentially have like more bargaining power with your suppliers. You have you ultimately gain scale and then are able to use that to leverage your margin and increase your margin. But other things are also just like as you continue, I guess like, so initially you have like these costs, some of which are fixed, some of which are variable. The variable costs will scale as the company continues to grow because they're variable costs, but you still have this very large fixed cost base that will remain constant. So as you continue to grow revenue, you're theoretically like decreasing your margin still because of the fact that only your variable costs are growing and there's still some amount of fixed costs that doesn't grow at all. So like margin expansion should like naturally happen, but I think like within private equity firms, especially for like private equity firms that are buying, I would say like smaller companies and companies that are considered like less, I guess, like less professionalized, I think like EBITDA margin is really where a lot of people see edge. Like people just see that they can run, certain companies better than maybe like mom and pop owners and like really make a difference in terms of like the operational efficiency. And I think this is where it gets into like, thinking about workforce, cutting like the fat in the middle of like certain companies. And that's really how you get like margin. And then the last thing to think about with private equity, I think, which is not necessarily related to to operational improvements in terms of like an EBITDA growth perspective, but is also just like a core matter of fact in like private equity, is that like, unlike in the public markets, you are not guaranteed to like buy the given company that you want. Like, and your highest offer doesn't always necessarily mean that you're the winner. I think like for a case study from like my summer, for example, something that we had thought about a lot was like we were dealing with a company that like vaguely operated in the insurance space. And like something that like Bain Capital has done is like we have people on our operations teams who have had like relationships with like CVS, Aetna, like United Healthcare, etc., who like ultimately thought that they could bring a differentiated approach to the company's operations and like a differential relationship to like the company's current like board that would like really be different from like other private equity companies that don't have necessarily as focus of like an insurance focus. And like ultimately we were able to like make a bid that was lower than like some of the other firms that can afford to pay higher prices than we do, but like ultimately differentiate ourselves on the fact that like we know how to run the company best. And like, returns for the company also mean returns for the people who like work there and who want to sell the company to you. So ultimately, like, I think establishing a right to win, particularly with like industry ties, as well as like really like your operations teams, is like quite important.
Thank you, Caroline. Okay, and last thing before we move on from private equity, I want to just quickly talk about, these are the three main return drivers and like, what does this look like over time? So the left bar in each of these segments is pre-2000. Then you have the period between the dot-com bubble and 2008 global financial crisis, and then post-global financial crisis. And I want to pose a question to you guys. If you look on this right graph, that 25%, that's 2000 post GFC. Why is the return attributable to leverage so much lower? And just for context, the average 10-year yield, so essentially the cost of leverage, was 8.53% in the period before 2008 versus just 3.71% on the year for the time after. So you have a lower cost of leverage, but less of your returns are attributable to leverage. Do you guys have any theories as to why that might be?
More people buy.
What do you mean by that?
Everybody's doing the strategies.
Yeah, so that's one thing, that alpha erodes. So similar how when we talked about merger arbitrage strategies and how, Bloomberg has a merger arb page now. Merger arb doesn't have as much alpha as it did in the 80s or the 90s, right? So if everyone has done all the financial engineering that's possible, a lot of those companies aren't able to be financial engineered as much. I think one other thing that I think is probably more like a direct cause of this is post GFC, you have all of these regulations, which we'll get into in a bit, that make it harder for investment banks to actually provide these leverage facilities. And this is why you've also seen a huge rise in private credit post 2008, because now when private equity firms want to take out that 50% leverage we just talked about, or that 80% leverage to buy a company, they can no longer go to a commercial bank or an investment bank to get that, right? They have to go to these private credit facilities, and that's been fueling that boom. Like Caroline had mentioned, post 2000, you might have seen really high EV to EBITDA multiples. And that's probably why pre-2000, you actually see a decline due to multiple expansion, because maybe someone bought a company at the peak of the bubble at like a 15x EV to EBITDA multiple, and then they sold it at 9x. So you actually lose money attributable to multiple expansion. And she already mentioned this, but one other reason that I think she hadn't mentioned was actual platform building. So this is another return driver that private equity firms use. And the whole concept is that if you work at a huge firm like Bain Capital, your check sizes have to be of a certain size, right? They don't have the teams to go look at $150 million companies, right? They'd rather just write one $5 billion check rather than look at a bunch of tiny companies. And so if you buy a bunch of tiny companies, collect them together and increase the total purchase price, you have less bidders on that company, right? So there's higher demand from those bidders because there's only so many companies of that size that inherently drives up multiples, EV to EBIT multiples. Okay, move on to debt real quick. Say the prices. Or just go.
Okay, so thinking back of like what that actually is, we're going back quickly to the capital structure. Debt is like the other main way, aside from equity, in which a company can finance its projects. And these are kind of the main parameters of debt. You have the principal amount. This is how much the debt will pay at maturity. Maturity being the date the debt expires. You have coupons, which are kind of like these interest payments on the debt. You have collateral, whether or not that debt is secured by something else, and then payment frequency. This is like the kind of primary stuff, but it can get like way more complicated than this. Just what I want to articulate with this page is what's the difference between debt and equity from like an investor's perspective. So in previous lectures, we talked a lot about from like the company capital raising perspective, what is the difference between debt and equity. But from the investor's perspective, the main thing I want to draw upon is something called like negative convexity or concavity versus positive convexity. So this graph is not the best articulation. So think of like a company that's worth 100, and you have 50% of it debt and 50% of it like equity. If the asset value changes, what would the payoffs look like? So you have this is the payoff of the instrument, and this is the asset value of like the underlying. So initially you see it's 100, and now this is like 100, and this is 50. So if the asset is worth up to 50, this is the debt. The debt will get paid off how much the asset is worth below 50. But if the asset is worth above 50, then the debt gets nothing because its payoffs are capped. So the payoff for debt will look something like this. And this is a concave function, so capped upside, or in finance you call it negative convexity. On the other hand, if you're like the equity holder, if the asset is worth less than 50, you're not getting anything because you're lower on the capital structure than debt. So debt gets everything. However, after 50, you get everything else. And as you can see, this payoff is convex. So that's the main thing, I guess, we
Does everyone understand this point? I think this is pretty important. Any questions about this? Okay, yeah.
And something else that's different between debt and equity is that debt has something called ratings, which describe how safe or secure that instrument is. And these are put out by these rating agencies that are nationally recognized by the SEC. Why is there ratings for debt but not for equity? That's because typically the investors in debt are like less sophisticated. Most of the debt investors are those like huge pension funds who don't have as much, right? That's what people like. That's what our boss
Yeah.
told us. Like,
I think maybe they're less sophisticated, though. I don't know if I'd say that. I think the main driver is that when someone issues debt, they hold all the information about the company, right? If I told you, oh, here's a bond for up $100, you don't know what my likelihood is that I'm gonna pay that off. Whereas in equities, you have all the information reported by the SEC publicly, right? So there's a lot of information asymmetry. And that's why to solve this information asymmetry, you have these third-party rating agencies, which will go in and say like, okay, here's how we price this to AAA, to AA, and Jason will get into what exactly that means.
yeah, but there's like another issue with the model of like these credit rating agencies in that they're paid for by the underwriters of the debt. So if I'm the debt holder, I'm the one paying these rating agencies to put a label on my debt to help market it. And what ends up happening with this kind of business model is that if you're the underwriter of the debt, you have huge power in kind of shopping your offers between the different rating agencies to try and get the best possible rating as well. And we'll get into why this ended up being like a huge.
This was the big problem in 2008, right? Yeah.
How does like varying interest rates affect like the demand for debt?
So varying interest rates would just change the coupon payment, or if you go floating rate like debt instrument, it would just change what that rate is paid. But in terms of the demand for debt, obviously if rates are higher, people are going to want that higher rate. Whereas if rates are low, like what the period we saw between 2008 and like 2020 with like really low interest rates, if I'm an investor looking to invest in debt, maybe I'm getting 2%, 3%, 5% yield, whereas equity markets are giving me 13%, right?
Does the debt fluctuate with the interest rates, or does
Yeah, that's a great question. We'll get to that in a moment. So just to answer your first question, typically when interest rate goes up, you are able to get more yield of just holding this sort of like risk-free instrument. So the demand for debt does go up when interest rates go up. However, the price of existing debt goes down, and we'll cover that in a little bit.
Yeah.
So existing price debt will go down.
Yeah.
But one second. So these are kind of how the rating agencies describe the safety of the bonds. They assign the credit rating from AAA down to D. And basically the higher the rating, the more safe it is. And there's a big distinction between BBB and above, which is known as investment grade, and BB and below, which is not investment grade. And the reason this is important is that a lot of institutional investors have either are under certain regulation or certain internal policies that means that they can mainly or only invest in investment grade bonds, which results in them being more in demand than what their expected yield might result, which we'll get into also in securitization. So what justifies like the rating on it? Well, there's many things from my covenants and all this other stuff, but the main thing is where it is located on the capital structure. So if you look at the capital structure, from AAA down to B, this is all the debt and equity at the bottom. And there's sort of this trade-off as you go up and down the capital structure between security and control. If you're higher up on the capital structure, you take losses only when everyone below you on the capital structure has already been wiped out. So it's a safer position. But being higher up on the capital structure means you have less control over the business. So there's something called a fulcrum, which is the lowest on the capital structure that has not been wiped out yet. And this is the holder that has control over the operations of the business. Typically in normal operating conditions, this is the equity holder. However, in distress situations, when you have this asset value go down, the fulcrum is the lowest on the capital structure that's not completely wiped out. In that graph, it's the BBB, that's the fulcrum. And some investment funds actually focus on trying to own companies for cheap by buying or trying to identify where the fulcrum will be in a distressed company. There's a company called Monarch, and it's called like loan-to-own structure. And to your question about the interest rate and demand and things like that and pricing. So how do you price that? Well, if you recall back to like a past section on fundamental asset pricing, you'll realize that any cash flow can be priced at its present value by discounting its future cash flows. And a bond is the same. It has future cash flows, so you can price it back to the present. Quick thing is that its face value its coupon, its time and maturity, these are all known things. They'll say when the bond is being issued. Something that is not as explicitly told is like the yield to maturity. And so this is where it comes in of why when interest rate goes up, the price of the bond goes down. So if you remember to the capital asset pricing lecture, this R value here, this discount rate is a function of how risky these cash flows are. And it's the same with yield to maturity. And for a bond, there are three main risks. You have the opportunity cost, the liquidity risk, and the default risk. So the opportunity cost is the risk of not investing in another risk-free asset. The liquidity being that you might not be able to sell the bond easily at a fair price. And finally, default is, the bond holders don't pay you back. And combining all of this, we have a formula of how we can calculate the discount rate, which is the risk-free rate plus the liquidity premium plus the default risk premium. So his question about what happens to the demand of a bond when interest rate goes up. So when an interest rate goes up, this risk-free rate goes up. And what this means is that you are discounting your future cash flows by a higher discount rate. So the present value of the bond goes down. So there's like this inverse relationship between the risk-free rate or the interest rate and the present value of bonds. And this is a bond pricing example. You guys, we don't have time to cover this, but I highly recommend take a look.
Yeah, go over it like really quickly.
Okay.
Just like really quick.
So consider like a company that's worth $100 on the right. 40% senior debt, 40% junior debt, 20% equity, all debt, zero coupon, 5-year maturity. In 5 years, there's two main states a company can get. It's either worth 120 or it's worth 60, 50-50 probability of each. And the current 10-year treasury is trading at 5%, whereas Apple bonds are trading at 5.7%. So how do you think about this? So if you look back at the previous formula, this is the bond pricing formula, but notice that there's no coupon. So we only have to worry about discounting the face value of the debt by how many years it takes. So in this case, both junior and senior is $40 face value over 5 years. So the only thing missing is like the yield to maturity. How do we calculate this? Well, we're told that the 10-year treasury is trading at 5%. So that's the risk-free rate. Next, you have to add on top of that the liquidity premium. If you look, you see Apple bonds are trading at 5.7%. And if you think of Apple bonds, these are a very safe company. So that means the only thing that's resulting in that 5.7% being higher than the treasury yield is the fact that Apple bonds or just corporate bonds in general are not as liquid as treasuries. So that's where the 0.75% comes from. And then the final thing is the expected default rate. So if you get these two cases, you'll see that in both cases, 1 and 2, the senior debt is not touched. It does not take any losses. So if you look at the default of S, it's 0%. That means the yield of that senior note is the same as Apple yield, just 5.75%. However, for the junior note, you'll see that in case 2, it's wiped out 50%. So this is 50% wipeout, 50% chance. So that means the expected wipeout is 25% over 5 years. So 5% annual. So then you just add that 5% on top of the previous formula and you get a yield to maturity of 10.75. And when you plug it back into the original formula, you'll see that because of this higher expected default, this higher discount, the junior debt price is lower than what the senior would currently demand.
I think that the core idea here is that interest rates are somehow related to the implied default probability of a credit instrument. So when you see a higher interest rate, it doesn't necessarily mean you're just getting free money. It means that the market's pricing in some default rate or some probability of default of that company.
So we talked about very simple zero coupon and coupon bonds, but debt can become very complicated. There's all these different things that you can add on to debt, different flavors, and all these different things that will change how debt is priced. If you're interested in leverage finance, you'll need to know this. And if anyone's going into like the financing side of investment banks or credit investing, you'll need to know this. I'm happy to like walk over this whenever if you guys want to shoot me in, but you can also find this on like Wall Street guys and things like that. I guess the main thing is like, so you have all these forms of debt. Does that change the value of a company? Like how is capital structures financed? Well, there's this famous economics professor who in the 1950s developed this theorem that said a company's present value is only determined by its future cash flows. It doesn't matter what its capital structure is. So if you look at these three capital structures, whether it's a 50-50 split between debt and equity, or this split between equity and different types of debt, or this split between 2 types of equity and 8 types of debt, it should not change the value of the business.
Just one really quick thing. There was a question earlier I missed about who are PE firms selling to when they exit a position. Other PE companies, are they going public or a competitor company? And the answer is all three. Other PE, if you are a general partner and you sell to another general partner, that's sometimes called a secondaries transaction, because you're giving it to a secondary interest. But generally, monetization methods cluster around selling to other PE companies, IPOing, and selling to another like actual corporate entity. So yeah, all of the above, I'd say for that. Sorry.
No worries. So yeah, in theory, no matter how you split up the pie of a company, it should be worth the same. I think a bit like a pizza. If you have a pizza, no matter how you cut it, does the value of that pizza change depending on how much you give to each investor? No. But does this work in practice? Like most things, not really. And so in practice, you'll find that certain debt investors might be willing to pay a premium on top of the expected yield on that instrument based on like default probabilities, risk-free rate, and liquidity premium because of certain regulations or certain like internal mandates that they have to follow. A common example is that AAA debt tends to be very in demand by these huge institutional investors. So whilst if you really analyze the capital structure and you see that, oh, this AAA tranche should be yielding 6%, somebody may be willing to buy that for 5.75%. So what you can end up doing is that if you have this capital structure of equal amounts of AAA, AA, and BBB, you could actually make more AAA at the expense of making the other tranches worse, but end up having the actual value of your business be higher because that AAA is valued more than it intrinsically should be. And this is, we'll get into more, so like what the consequence of this is when Sid talks about securitization. And back to the pizza, the way I like to think about it is that, for example, you have this pizza on the left. If I know that pepperoni pizza is most in demand, I would cut this pizza in a way such that I can sell as many slices of that pepperoni pizza as possible. So if you see at the left here, there's 2 separate chunks of pepperoni. I'm not going to have that on the same slice. I'm going to cut it so that they're on different slices. So instead of selling like 1 pepperoni pizza, I can sell like 2 different slices. Or something along those lines. But I guess that's a way to think about it. And quickly to wrap it up, this is the credit universe. Like what are the strategies? There's core credit strategies. These are the strategies that are focused more on the investment grade bonds. They're exposed mostly to market risk. As you saw before, in senior debt, most of the yield comes from that risk-free rate. And because of that, they're very sensitive to rates. Typically investors in core credit really take a top-down view of like what is going to happen to interest rates. And because of this, there tends to be like a big correlation between investment grade bonds in different sectors. This is not the same with opportunistic credit. Opportunistic credit is really focused on non-investment grade bonds. And as you saw before, like with the junior debt, most of its yield came from not the risk-free rate, not the liquidity premium, but the idiosyncratic expected default probability. And because of that, high yield bonds are very sensitive to specific companies. They exhibit a lot of idiosyncratic risk where, when a specific company situation changes, that will really affect the price of that bond. And because of this, companies who invest in opportunistic credit, they really take a bottom-up view of starting from the specific company and then going up. Whereas core credit focuses on like, oh, what's going to happen in the larger macro environment and then going down.
There's like a quote our boss told us, I think it's from like Dostoevsky or something. It's like all happy families are happy in the same way, but all unhappy families are unhappy in their own way, or something like that. So like,
oh, that's good. Right?
Yeah, every like distressed high yield junk bond is separate. Right? Like you can't generalize to all.
Yeah, sorry. And the last sort of like credit strategy is private credit. Now, unlike opportunistic and core credit, when you're investing in publicly traded debt, private credit is something different, where instead of investing in publicly traded debt, you are actually providing debt to companies, and to companies without traditional access to financing. Why this is the case, I'll cover in a moment. But essentially, because you're providing these loans, you actually are able to satisfy a lot of different areas of the capital structure. You can really cater your loans to the specific needs of different companies. And so you can actually give off a lot of different types of loans. And this is like a very good thing. We'll cover in a bit. But two other things I want to quickly cover is that the returns of private credit firms are really stable. And the reason for this is, unlike opportunistic and core credit, which is focused on, making returns on price movements of the underlying bonds, private credit is really just focused on giving out loans and having people not default on those loans. So the returns are much more stable. And really quickly, what you have to understand is private credit is kind of like a new investment kind of fund that happens post 2008. And essentially the reason for this is because after 2008, banks were loaded up with a lot of regulation that stopped them from being able to give out loans so easily. So these private credit vehicles kind of jumped into that niche to fill the gap left behind by these investment vehicles. Yeah.
Okay, 15 minutes to explain mortgage-backed securities now. Okay, so I guess this starts with, the American dream, right? You meet your wife, you get married, you fall in love, and you say, okay, we want to buy a house. And you decide we want a big house. But the problem is, it's $1 million and your lifetime's joint savings are only $200,000. So are you not able to buy this house? You have to wait, 5 more years until you can save up enough money to buy this house. And obviously in America, we would never let that happen. So we created this thing called mortgages. And this is not actually created in America. It goes back to like France, I think. But essentially what it is you enter a contract with a bank. The bank puts up some amount of money. You put up some amount of money. You get to own the house, but the bank has is using the house as collateral. So if you default on your mortgage, the bank can then seize the house, sell it in the market, and recuperate their initial investment. And I guess this is pretty important because all of us will probably take out mortgages at some point in our life. But the key things that define this contract. So you have your term, and this is generally over how many years are you going to amortize this contract. And what that means is that I'll get into what an amortizing loan is in a second. So I'll wait till then. Then you have your interest rate. You can either have like annual percentage rate, so including fees and everything, how much interest are you paying on your principal? And this can either be fixed or floating. So an adjustable rate mortgage, for example, might be SOFR plus 4%. SOFR plus the spread. And the down payment. So what percent of the actual property value do you put down as equity? So in the previous example, you put down 200K, the bank gave you 800K. That's a 20% down. Your loan to value ratio is 80%, right? And I guess a question to kind of think is, if you're a bank, would you prefer a higher LTV or a lower LTV? Lower. Why?
Loan goes bad and goes to house.
Exactly. Yeah. And so actually what happened in 2008 is a lot of people at the end of the crisis actually had LTVs that are higher than 100%. So even if you sold the collateral at market value, you're not going to recuperate the initial principal. And we'll get into exactly how that happened. But you can see generally 30-year rates are higher than 15-year rates. And question for you guys, why is that the case? I guess I'll stop. Yeah, like markets are less predictable over longer time periods. They might be more stressful, like a big crisis might happen or something. Yeah, and I guess the other questions are kind of already answered. Yes, LTV can be whatever. If you're stupid enough to give out a loan and it goes up to 500% LTV, you probably wouldn't underwrite that loan on the day of with 500% LTV. But if the markets crash, your collateral value falls, that could be the case. And so now we'll talk about how mortgage-backed securities are created. So let's say a bunch of people have money, they deposit it in your bank. That's a liability. You owe that money to people. But you're a bank, so you want to also make money on the money that people gave you. So you issue some mortgages to a bunch of people that you evaluated, you think are very safe. They're going to pay their mortgage. They have jobs and families and stable cash flows, whatever. And so the bank took in liabilities and lent them out as mortgages. And the mortgages represent an asset to the bank, right? It's a contractual obligation that people will pay the bank. Is this a good idea? What are the risks for this bank? If you are an investor, would you go and start a bank that does this function? You would? Okay, and let me give you a situation. All your depositors come knocking on your door saying, can I get my money?
Oh, I only let people bank at my bank if they're not.
Oh, yeah, interesting. But yeah, the core issue of this bank is something called a maturity mismatch. So what that means is liabilities have a short maturity, which means that within 30 days people might want their money back. A mortgage is a 30-year maturity, right? You're not getting your money back. You're not getting your principal back until 30 years down the road. And this is a big problem for banks. If there's a bank run, if there's a global financial crisis, people want their money back, you have to buy or sell your assets. That can cause a lot of money to be lost. And you have a lot of regulation. And we already kind of went over a little bit of that, but Basel III, Dodd-Frank, all after 2008, they put a ton of these regulations on banks. Okay, another issue is what if more people want mortgages? You have to go and find more people to deposit money in your bank. And if you operate in a small town like Princeton and you don't have any other branches and you have 100% market saturation, you can't get more money unless all your customers start making more money and deposit the money with you, right? So but let's say someone else wants a mortgage, you can't give them that mortgage. And what if someone else wants it? We know that there's investors with all kinds of risk appetites. What if someone else wants this mortgage contract that's relatively stable, gives a lot of cash flows, and is very predictable? What if I, as an investor, want access to mortgages? Most investors can't go and underwrite private mortgages. They don't have the facilities for that, and so this is where you get mortgage-backed securities. And the idea is if there's a bunch of commercial banks that have given out a bunch of mortgages, an investment bank can come along and say, hey, I have a ton of money. I'm going to put this in this bankruptcy remote special purpose vehicle. And the purpose of that is the investment bank can't get in trouble if the mortgages fail. They give the commercial banks money and they get the mortgages. So they traded cash for another asset. And this becomes the asset of the special purpose vehicle, right? This is a contractual obligation to pay. And now what the bank can do is go and create what Jason already discussed, right? Hierarchy of capital, a capital stack, right? With equity at the bottom, which is retained by the investment bank. And the idea here is that whatever's left over, if they're taking the dollar first loss, it's in the investment bank's interest to not make a crappy mortgage-backed security, right? To not fill it with a bunch of junk loans because they're the ones taking the dollar first loss. Obviously, they make money on fees and other underwriting things, but generally that's the theory there. We already talked about AAA mandated investors, people who want really safe cash flows. So a credit agency a rating agency can come along and rate, this percentage of the stack is AAA. That'll go to AAA mandated investors. And we already talked about opportunistic credit. What if the market's pricing the default probability a lot lower than it actually is, or a lot higher than it actually is? If I'm a smart investor, I can go and make money off of that. But then what do you do with this mezzanine debt, this middle kind of area? Who wants to buy that? AAA mandated investors don't want that. Credit investors can make more money on the lower end of the capital stack. So what do you do with it? And I guess if you're really clever, that's a collection of cash flows, and you can just put it into another collateralized debt obligation. And you do the same thing, and you get rid of, the AAA and the double and the equity and the BB, whatever, to the respective parties, and you do it again. And so now you've created three assets, essentially, or three liabilities that are all backed by some mortgage, right? And this is what caused it, or not caused, there's a lot of causes of it. But one of the issues in 2008 was that you had these CDOs and CDOs squared and CDOs cubed, where all of these cash flows and all of this money was dependent on some small portion of mortgages. And another problem with 2008 was that these underwriting standards, so the commercial banks that actually gave out these mortgages, they knew that they didn't have to hold the risk. The commercial bank wasn't holding the risk. They sold it on to an investment bank, who then sold it to pension funds and whatever else. So if I know that no matter what junk mortgage contract I write, I can sell it, what am I going to do? I'm going to start giving out these really trashy loans. And these are actually called ninja loans. So no income, no job, or assets. And this is a real thing that happened in 2008. Everyone could just go, and if you watch The Big Short, you see that scene where he goes to Vegas or something, and he meets like this adult entertainment dancer, and sees like she has 4 houses and like 4 different mortgages, and he realizes the extent of this issue is that all of these people are going to default on their loans, but the commercial banks that underwrite those loans, the people who got the bonuses for writing 100 mortgages, they were removed from the risk. And this is like the principal agent problem, where the person who holds the risk is separate. Or I guess it's not the principal agent problem, but regardless, the person who holds the risk is not the one who actually initiates the contract. And so, yeah, you can do that, and you can do this with mortgages, but you can also do this with anything that has a contractual obligation to pay. So car loans, for example, aircraft leases, credit card receivables, your credit card debt, your student loans, power purchase agreements. If you have a solar plant that has stable cash flows, you can securitize that. Even Domino's Pizzeria, and this is an actual thing that happened, right? Domino's took their franchise fees, profit, and whatever, and they raised a bunch of money, and they got rated AAA or triple B plus, and they raised 1.2 $7 billion by doing this, right? So you can literally securitize anything that has, or let's talk about that actually. So in an asset-backed security, an ABS, what is the asset? If you have an art collection, could you securitize that?
What does it mean?
To make it the backbone of writing debt against that asset. To put it on the left side of that picture with a mortgage where. You think so with an art collection?
If you had like a expert give a reading.
But then someone's gonna buy it, like they're willing to buy it from you, that's certain. Right?
Well, that's just a normal sale, right? Can you securitize it? Can you say, here are the cash flows from this art collection, I'll give to someone?
Oh,
An art collection doesn't really have cash flows, right? So what are those qualities that make an asset securitizable? And this is why I kept saying it, the contractual obligation to make payments. So the asset in a securitization is not the collateral, it's not the houses, right? It's not the houses the mortgage was written against. It's actually the actual mortgage itself, the loan. That is the asset in this situation. And so the assets of the SPV are, so of that special purpose vehicle, the assets of that are the mortgages. And on the payer's balance sheet, if I'm a person who took out a mortgage, it's a liability. So the liabilities of me as a homeowner are now the asset of this special purpose vehicle. Yeah, and so the collateralized nature of this means that, you know, if I default on my loan, the person who runs that SPV or who manages the cash flows can go and seize my house and sell it, and hopefully the investor can recuperate some amount of their investment. And another issue that that was a factor in 2008 was this question, right? Is the value of the collateral, so in this case, like let's say a house, backing the contract, the mortgage, independent of default? So if I default on my house, does that change the value of my house? Okay.
Actually, a lot of people.
yeah.
Exactly. So this is like when you have these tail events, these black swan events, home price appreciation was a very, very well understood phenomenon, right? From 2000 to 2006, this is the Case-Shiller index. It's like a national home price index. You can see that, you know, you had very steady growth in home prices. And so if I know as a bank, I issue a loan at 80% LTV, and then even if the borrower defaults 5 years from now, that home will be worth double what the collateral was written at. Now it's only 40% LTV, right? Because the collateral's value doubled. So I know that no matter what loans I make, as long as home price appreciation keeps happening, it's very hard for me to lose money on this deal. Because if the borrower defaults, I just seize the home and I sell it at a higher price than what I underwrote the loan at, right? So this also fueled a fire where now let me just write loans on whatever I can, or write mortgages and contracts on whatever I can, because I'll make money even if the person defaults. And so when multiple tranches of debt are backed by the same pool of assets, in the case where we had the initial mortgage-backed security, the CDO and the CDO squared, you can see how this risk gets magnified, right? Because now if there's a default in all the initial mortgage-backed securities, or in the initial on the left one, the mortgage-backed security, that loses a lot of value, then the subsequent CDO and CDO squared also lose value. And this was a huge issue and ultimately led to what we all know as the global financial crisis. Yeah, so I guess this is an example of the bank losing money even if it defaulted, and I don't think we need to talk, I think I already explained all this. Okay, this is an amortizing loan example. So typically in the private equity case, when you take out a loan, it typically follows something called a bullet payment. So that means you pay interest only for the first, I don't know, over the term of the loan for 5 years, you pay interest, and then on the day you sell the company, you pay off the principal amount. So I'll give numbers to this. If the principal is $100 and you have 10% interest over a 5-year period, you pay $10, $10, $10, $10, $110 in year 5. An amortizing loan, on the other hand, is if you know cumulatively you have to pay $150, you would pay $30, $30, $30, $30, $30. And as you pay off more of your principal, your subsequent interest payments get reduced, which is why this isn't like a linear thing, it's more of a curved graph. And because if you're reducing your principal, you have less interest is applied to a smaller quantity, so your interest payments subsequently get less and less. And so let's talk about how exactly the cash flows through securitization. You have a mortgage contract which generates cash, right? Every month, on the first of the month, you get a big check of money from all the people who have mortgages, and the SPV receives that money. And they take some fees, obviously, because they have to service these loans, they have to call homeowners, make sure they're paying, they have to deal with it in case of default probability, whatever. And the way that it actually flows through, and the reason why AAA might be rated AAA versus BB being rated BB, why is that the case? Well, it's higher in the capital stack, right? So any extra payments get paid, any principal payments get paid to the AAA until it's fully retired. And what that means is if everyone pays $100, half of its interest, half of its principal, all three or all four debt holders will get their interest payments, but only the AAA will get their principal amount. And so the result of this is that the AAA tranche has a shorter weighted average life. This is like another term you have to know for securitizations, and that means that it'll get retired a lot quicker than the other ones. And so you can see this in this graph, right? So pretty much just go from 60 on. You can see that AAA gets retired before AA, before A, and BBB and BB, right? So as you flow down the capital stack, it gets retired faster. And what this also means is that if there's less cash flow than expected, the people who take the first loss are these BB people, right? And so the subordination is one method of credit enhancement. And so this is an actual securitization by Ford. Obviously, if you sell a bunch of cars, you're going to naturally give out a lot of car loans as well. And Ford actually gives those loans themselves, right? So they have a lot of receivables that are going to come in. Ford's like, I don't want to wait around for 20 years or 5 years, whatever, while this car loan pays off. I want the money now so I can go invest in EVs or whatever. So they securitized it and wrote it up and sold it. And you can see over here, this area, this is known as credit enhancement right here, I guess all of this. And so credit enhancement is actually how you get your debt tranches to be rated higher. So there's three main methods of credit enhancement. One is excess spread. So for mortgage-backed securities, for example, if the average interest payment is 6% from people coming in, less 50 bips of fees, let's say 5.5%, the SPV is ready to hand out. Maybe they only give the debt at 4.5%. So you would have some amount of excess spread, and that means that even if you lose money, even if people aren't paying, even if people default and you can't recover the capital, you're still able to pay off the money because all this excess spread you've been collecting. The second is over collateralization. So if my initial pool of mortgages is worth $100 million, maybe I only issue debt for $80 or $90 million and retain the rest as equity. This means that the first $10 million of loss, none of the debt holders even experience. And so that helps to get rated higher because $10 million of loss only happens in a global financial crisis type environment. AAA will never get touched by that, right? And this is what Jason was talking about the expected default probability. If you're high enough and there's enough over collateralization, you won't experience any pain from defaults. And we already talked about subordination, where if you're higher on the capital stack, you'll experience losses much later than everyone else. And in bond markets, there's generally four main risks. The first is duration risk. So remember how we talked about as interest rates go up, bond prices go down. This is because of the opportunity. You'll learn a lot about this in your econ classes here. Like this is probably the most covered topic. I don't know why it's so boring, but you'll learn all the formulas for calculating duration and how it works and convexity. I'm not going to cover it that much. Credit risk we already kind of talked about. That's essentially the default risk. Is this credit instrument going to default? And that's related to its rating. And the third is liquidity risk. So what Jason was talking about, how corporate bonds are less liquid than US Treasuries, for example. Can you sell it at the time you want to, or do you have to wait 2 months to be able to sell the security? And the fourth, which is kind of unique to securitization / mortgage-backed securities, prepayment risk. So with a mortgage, generally there's no fee to prepay your mortgage. So you can imagine that if you took out a $100 mortgage for 30 years, there's some amount of interest payment that the person who underwrote that mortgage is expected to collect, right? But if on year one, you suddenly have a huge inheritance and you pay off your entire mortgage, that person is not going to collect any more interest payments on the mortgage. So this is something you have to analyze. And you can see that, and I guess another term or another thing is if you took out a mortgage, let's say literally 4 months ago, maybe the 30-year mortgage rate was 8%, right? And if you go 5 years from now and rates are back down to zero, the 30-year mortgage rate is 2%. So you have an 8% mortgage, but you can get a 2% mortgage. You can just refinance that by taking out another mortgage, paying off your 8% mortgage, and paying the 2% mortgage. So you instantly kind of can make this money. And so this is obviously a pretty big risk. And you can see that as the incentive, so this is the percentage change here. So as, let's say you took out a mortgage at 8%, as rates go to 7%, 6%, 5%, this is how many people are going to prepay. This is their conditional prepayment rate. And you can see that in the other case where, the interest rates actually move up, people are going to be very happy holding the lower interest rate mortgage. Like if you took out a mortgage in 2019 at like 3%, you're very happy right now when mortgage rates are 8%. You're not going to do anything. You're going to sit on that, and the bank actually has to deal with that problem. And yeah, so I guess you can do this with anything. To review securitizations, you take any contractual obligation, put it in an SPV, and the reason you have that SPV is because it's bankruptcy remote, which means that even if everything defaults in there, the people who have the debt, so the debt in the SPV has claims to all the assets in the SPV, and if the investment bank had that debt on their own balance sheet, that means that the people, if everything defaulted, the people who own the AAA and the AA and the single A could go after the investment bank's assets. So that's why you place it in SPV, because it's bankruptcy remote. Why securitize? It's because any individual mortgage has, some probability of default. But the idea is if you take a huge aggregate of them and only take the top 40% of them, you'll probably be okay. And so you can reduce that idiosyncratic risk. Though there are really weird securitizations where people have taken single assets and securitized them, which pretty much defeats the point of securitization, because if you have a $2 billion rental building, this is a big thing in New York City right now because the office commercial real estate has kind of gone downhill since COVID. But essentially, people used to securitize single assets. So a whole building would just be put into a security, but obviously that doesn't have lower idiosyncratic risk. It's the same risk. And I guess one other question is, does the AAA or BBB tranche receive a higher yield? Yield being interest payment. AAA receives a higher yield. Why is it BBB? Higher, yeah, high risk, exactly. And are 30-year treasuries or Domino's asset-backed security more liquid? Domino's? Well, I guess I think 30-year treasuries are probably the most liquid credit instrument. I guess you have to know a little. Huh? Oh, sorry, 10-year, yeah. Well, the US government issues these treasuries all the time. So it's a very liquid instrument. Everyone wants treasuries, everyone trades treasuries. Yeah, TI has their Thursday open education session. And yeah, if you're new and you want slides, if you're not new, please leave us feedback. Yeah.
So basically the way that investment banks can sell that bad, those triple B's, the way they can sell those is by assuming the risk and then it gets bumped up to.
What do you mean?
They tell whoever buys that they'll cover it. I don't understand the squared thing. They take bad risks.
Yeah, so what happens is those middle tranches are just another collection of factors.
And how do they get upgraded?
Because